So mortgage rates are closing out today at the highest level we've seen since July of 2025. So that is a significant move in the market, and there it's about 0.75% higher than where we were just before the Iran war started. So to kind of understand what's going on, we got to back it up a little bit. So we started this year expecting anywhere between 3 to 4 rate cuts were priced into the market, and that was positive. Rates moved below 6% and the lowest levels in almost 4 years, which was a very positive development. We had a lot of buyer activity. We had a lot of pre-approvals that were being done, and buyer sentiment was very, very strong. Then the Iran war started. What the Iran war did is it obviously created a lot of geopolitical concerns, but what it really did is it drove up the price of oil. Price of oil going up over $100 a barrel caused a lot of inflation concerns. And now, over the last several weeks, we've had an employment report that came in very strong, so that's inflationary. More people having more jobs, spend money, that drives inflation. The second is we had a lot of inflation reports that came in much stronger than expected, and that is causing concern and what they call, inflation being a little bit sticky. But that is a reflection of oil prices. Now think about the longer oil prices stay here. Not only does it hit the consumer and affect their spending, but it also affects all the goods and services. Think about all the things that are delivered to grocery stores and everything. That gas that they're paying to deliver that food is going to cost more money, and the only people that make up that difference is the consumer with higher prices. That is a concern that the Fed has to deal with. So we are in this position where in the near term, it's going to be hard for mortgage rates to move lower. It's going to be hard for the Fed to lower rates. It's going to be, we're going to have this where rates are for quite some time. Now, moving forward, we have an election coming up in November that could sway some sentiment in the House and Senate, and that's going to change policy. That could swing rates one way or the other, but it's going to be hard in the near term, even with good positive news out of Iran, to move the bond market significantly lower from here. We've seen the bond market really repricing a lot of this now with a higher chance of the Fed raising rates than actual lowering rates. That is a big sentiment change, something to pay attention to. But as a buyer, it's always important to make sure that you're aware of strategy, even in times of uncertainty, even when times are when it seems like everything is going against you. These are the moments where you can actually take advantage of the market, get an offer accepted, negotiate, even try to buy down your rate, do some different things to be able to take advantage of where the current market's not the ideal situation, but you got to think about waiting. What is waiting going to really do? Do we think home prices are going to go down? Well, we have inventory at 63% below where it was in 2019. So we don't expect home prices to move lower. We don't expect a glut of inventory. It's just not available. And we don't expect rates to move much lower. So those would be the two reasons that you would be really wanting to wait. And we don't really see a lot of that on the horizon. So now is a chance to kind of reshuffle, reposition yourself, re-strategize for the market that we're in today and not waiting for the market to change in the future.